So picture this. You've got some surplus cash sitting around. Maybe it's a bonus, money from a recent property sale, or just a really solid safety net. And you're wondering, where on earth do I park this? You want it safe, you want it liquid, but man, you absolutely loathe the idea of handing over a massive chunk of your modest gains to taxes. It's a classic dilemma, right? It makes most of us want to pull our hair out. Well, today, in this explainer, we're doing a deep financial x-ray on one of the biggest market-neutral vehicles designed to solve that exact problem. We're talking about the Kotak Arbitrage Fund. We're going to look strictly at the data to figure out how it works, what the real risks are, and honestly, whether it actually deserves a spot in your portfolio.
Okay, here's our quick roadmap for today. 1. What are arbitrage funds? 2. Spotlight on the Kotak Arbitrage Fund. 3. Risk, volatility, and market cap. 4. Kotak versus peers and benchmarks. And 5. The Kotak advantage. Let's get into it.
Chapter 1. What are arbitrage funds? The cash and carry mechanism.
Now, right off the bat, an arbitrage fund is absolutely not trying to find the next big breakout stock. It's not trying to capture massive business growth, and it doesn't care if the overall market is going up or going down. Instead, it uses a highly specific strategy known as cash and carry arbitrage. Basically, the fund is just trying to earn the price difference between a stock in the cash market, the spot market, and that exact same stock in the futures market. The beauty here, it is a fully hedged strategy. You are literally locking in a spread, which means you have virtually zero exposure to the overall direction of the stock market.
Let's break this down into 3 really simple steps. Step 1, the fund buys a stock in the cash market. Step 2, at the exact same time, literally simultaneously, it sells the futures contract of that same stock for a similar expiry. Now, the futures price happens to be higher than the cash price. That little difference is your gross spread. Then, step 3. On the day the contract expires, the cash and futures prices converge. The fund captures that spread, and after their execution costs, well, that becomes your return. They just do this over and over again, repeatedly capturing those small, risk-mitigated spreads.
Moving right along to Chapter 2, Spotlight on the Kotak Arbitrage Fund. Scale, legacy, and performance.
Wow, just take a second to process this number. As of June 30, 2026, the Kotak Arbitrage Fund held a staggering 72,409.42 crores in assets under management. That is absolutely massive. And why does that matter to us? Well, in the arbitrage world, scale and liquidity matter immensely. This isn't some niche experimental fund. It is one of the largest, most enduring market-neutral investment vehicles in the entire Indian asset management industry. It really speaks volumes about the level of institutional trust they've built up over the years. And that kind of scale doesn't just happen overnight. The scheme's inception actually dates all the way back to September 2005. Think about that for a second. That means it has successfully weathered major market transformations, massive regulatory shifts, and severe economic crises over basically 2 decades. They launched the Direct Plan in 2013, and then in October 2019, Hiten Shah, a manager with over 15 years of hardcore institutional arbitrage trading experience, took over the operational management. It's just really fascinating to see that kind of longevity in this specific space.
Now, if we look at the historical performance for the Direct Plan growth option, the fund has delivered a highly consistent annualized return of 7.08% since its inception. Remember that cash and carry mechanism we just talked about? Right, they aren't out there chasing crazy market highs or placing aggressive risky bets. They are methodically, relentlessly locking in spreads, delivering a steady, roughly 7% return over the long haul through such a highly hedged strategy. That really highlights some serious execution discipline.
Chapter 3. Risk, Volatility, and Market Cap. Let's look under the hood.
So, here's a fun fact. To qualify for equity taxation, arbitrage funds have to maintain at least a 65% exposure to equity. But what kind of equity are they actually holding? Well, looking at their market cap distribution, a massive 75.64% of their equity exposure is parked right in large cap stocks, with about 21% in mid cap and just a tiny sliver, a little over 3% in small cap. Even though these positions are totally hedged, skewing so heavily toward large cap, super liquid equities means the fund can enter and exit trades with almost zero friction. This setup heavily favors conservative stability and really smooth operations.
Okay, let's geek out for a second and dive into the hard risk metrics. A fund's standard deviation basically measures its volatility, right? Like, how wildly do the returns swing away from the average? The Kotak Arbitrage Fund sits at a remarkably low 0.93. To put that into perspective, broad equity funds usually have standard deviations well up in the double digits. There's no way you're getting that kind of swing here. The fund also boasts the beta of just 0.26, which tells us it has minimal correlation with the broader market's ups and downs. Plus, A Sharpe ratio of 2.19 shows fantastic risk-adjusted performance, and an alpha of 0.10 means it reliably squeezes out just a tiny bit of excess return relative to the risk it takes.
So what does this all actually mean for you? This is absolutely crucial, especially if you're a beginner trying to figure out long-term capital growth. If you want long-term equity compounding, you'd normally look for growth metrics. You know, a higher beta, higher volatility, basically strapping in to ride the market's upward trajectory over decades. But Kotak's low beta and incredibly low standard deviation prove that this fund is actively designed to avoid long-term equity compounding. It's built from the ground up for capital preservation and capital efficiency. Actually, if you approach this fund expecting typical equity returns, you're literally looking at the wrong product.
Chapter 4. Kotak versus peers and benchmarks. Let's get some objective contrast in the market.
When we put trailing returns side by side across major peer funds over a 3-year period, Kotak delivered 7.66%, Invesco hit 7.60%, and Tata brought in 7.70%. Over 5 years, Kotak sits pretty at 6.85%. What you really need to take away from this is that in the arbitrage category, you are definitely not looking for wild spikes or some magic fund that just blows everyone else out of the water. Small differences here are usually just driven by execution costs and fund scale. Kotak's numbers show a deep, incredibly reliable consistency, and honestly, that is exactly what you want when you're just trying to park short-term money safely.
And stacking the regular plan growth option up against its benchmark, the Nifty 50 Arbitrage TRI, is super revealing too. Whether you're looking at the 1-year, 3-year, or 5-year marks, the fund's returns track the underlying benchmark index and the 1-year T-bill index very, very closely. It'll occasionally lag just a tiny bit or pull slightly ahead to generate a modest alpha, like we saw in those since inception numbers earlier. It basically proves without a doubt that the fund manager is staying perfectly true to the arbitrage mandate. No nasty surprises here.
Finally, Chapter 5, the Kotak advantage, the final verdict and utility.
So, the advantages we've seen today are highly structural. First off, you've got that massive scale. Second, it's steered by Hiten Shah's 15+ years of institutional experience, which guarantees that highly hedged execution to reliably lock in those spreads. And this is the real kicker. Because it maintains that 65% equity exposure, it gets equity-oriented tax treatment. For anyone in a higher tax bracket, that is a huge win compared to traditional debt funds. But we've got to be completely objective here. The primary structural risk with this fund isn't a stock market crash, it's spread compression. If the markets get too calm and boring, the gap between cash and futures narrows, and your returns will temporarily compress, making it look a lot more like a standard debt alternative.
Which brings us right to the ultimate question you have to ask yourself right now. Is your surplus cash working efficiently for you, or is it taking on unnecessary risk? If you've got money you just need to park for, say, 3 to 12 months, and you want to keep volatility ridiculously low while optimizing your post-tax outcome, well, the data clearly shows the Kotak Arbitrage Fund is a highly calibrated tool built specifically for that exact job. Just remember, tax efficiency should never ever substitute for overall portfolio suitability. Make sure the tool actually fits the job you need it to do. Thanks for joining me for this explainer, and keep learning.